Breaking news just hit the market and it's sending shockwaves across Wall Street, social media, and everyday investors who are wondering what this really means for their money, because reports are circulating that the White House is buying more stocks, and if this is true, it could change the entire investing landscape faster than most people realize. So stay with me because by the end of this video you'll understand what's actually happening, why it matters, and how smart investors could position themselves before the crowd catches on. Let's start with the big question everyone is asking: is the White House literally buying stocks? And the honest answer is more complicated than a simple yes or no, because the White House itself doesn't open a Robinhood account and start buying shares like retail investors do, but through government-linked funds, policy decisions, liquidity programs, and indirect market interventions, massive amounts of capital can and do flow into the stock market, and that's where things get very interesting. Over the past few years, we've seen unprecedented involvement of the U.S. government in financial markets, especially after major economic shocks, from pandemics to banking stress to inflation spikes, and one of the key players in this story is the Federal Reserve, which, while technically independent, works closely with the U.S. government to maintain financial stability, and when the Fed injects liquidity, cuts rates, or launches asset purchase programs, stocks almost always respond. When liquidity floods the system, it doesn't just sit in banks, it looks for returns, and historically, one of the fastest places that money flows into is the stock market, pushing prices higher sometimes regardless of company fundamentals, and that's why many investors believe government actions act like a hidden backstop for equities, especially large-cap stocks. Now let's talk about why these rumors are exploding right now. Recent policy discussions, emergency funding programs, and quiet balance sheet expansions have sparked speculation that the government is once again stepping in to support markets behind the scenes, and when traders hear that kind of narrative, they react instantly, because they remember what happened in previous cycles when government intervention triggered massive rallies. Look back at history and you'll notice a clear pattern. During times of crisis, markets panic first, then policymakers respond, and then stocks rebound sharply, sometimes creating generational buying opportunities. And that's why the idea of government-linked stock buying is so powerful, because it suggests a safety net that reduces downside risk. This brings us to the psychological impact on investors. When people believe the government is effectively supporting the stock market, fear decreases, risk appetite increases, and sidelined cash starts flowing back in, which can create a self-fulfilling rally where prices rise simply because everyone expects them to rise. Institutional investors understand this better than anyone. Hedge funds, pension funds, and large asset managers closely track policy signals, and when they see supportive language from Washington or the Fed, they often increase equity exposure, particularly in sectors that benefit most from government spending and economic stimulus. So which sectors could benefit the most if this trend continues? Historically, technology, financials, defense, infrastructure, and energy tend to see strong inflows when government support ramps up, because these areas are deeply connected to national priorities, economic growth, and long-term policy goals. Think about technology for a moment. Government contracts, AI investments, cybersecurity spending, and digital infrastructure all funnel money into tech giants and emerging players alike. Companies like Apple, Microsoft, and Nvidia often become indirect beneficiaries of policy-driven growth, even if the government isn't buying their shares directly. Financial stocks also play a crucial role, because when liquidity increases, banks and financial institutions see higher trading volumes, stronger balance sheets, and improved profitability, which can lift the entire sector, and that's why names like J.P. Morgan Chase and Goldman Sachs tend to outperform during periods of aggressive policy support. Another major area to watch is defense and aerospace. Government spending in this sector is massive and often resilient even during economic downturns, and companies tied to national security frequently see stable cash flows that attract investors during uncertain times. Infrastructure is another silent winner. Roads, bridges, clean energy, and public works projects inject billions into the economy, supporting construction firms, material suppliers, and renewable energy companies, creating long-term growth narratives that Wall Street loves. Now let's address the biggest concern critics have: is this market manipulation? Some argue that heavy government involvement distorts price discovery and creates asset bubbles, and there's truth to that concern, because when prices rise primarily due to policy rather than fundamentals, corrections can be sharp and painful when support is withdrawn. However, supporters argue that preventing market collapse protects pensions, retirement accounts, and the broader economy, because a crashing stock market can quickly spill over into job losses, reduced consumer spending, and economic contraction. For retail investors watching this unfold, the key is not blind optimism but informed strategy. Understanding that government support can boost markets doesn't mean every stock is a buy. It means focusing on quality companies with strong balance sheets, durable cash flows, and alignment with long-term policy trends. This is where indexes come into play. Broad market exposure through benchmarks like the S&P 500 often benefits the most from liquidity-driven rallies, because large, established companies receive the majority of institutional inflows, making index-based investing a powerful way to ride policy-driven momentum. But there's also opportunity in selective growth stocks, especially those tied to innovation, defense, infrastructure, and energy transition. These areas could see sustained support beyond short-term market moves. Timing also matters. Markets often move ahead of official announcements, meaning by the time headlines confirm government action, prices may have already adjusted, which is why staying informed and proactive is critical. Another important angle is global impact. When the U.S. government signals market support, global investors take notice. Capital flows into U.S. assets from around the world, strengthening U.S. markets relative to others and sometimes weakening emerging markets as money reallocates. This global dynamic can amplify rallies and increase volatility, making risk management essential. Diversification, position sizing, and disciplined investing become even more important in policy-driven markets. Now let's talk about what could go wrong. If inflation reaccelerates, interest rates stay higher for longer, or political gridlock limits policy effectiveness, markets could react negatively, even with government involvement, which is why no strategy is risk-free. That's why smart investors watch not just headlines but data. Inflation numbers, employment reports, earnings growth, and liquidity conditions all help confirm whether policy support is translating into real economic momentum. So what's the takeaway from this breaking narrative? Whether or not the White House is directly buying stocks, the reality is that government actions continue to play a massive role in shaping market direction, and ignoring that influence is a mistake many investors can't afford to make. For viewers of Stock Predictor, this is about staying ahead of the curve, understanding the forces moving markets, and positioning intelligently rather than emotionally, because opportunities often emerge during moments of uncertainty and controversy. As this story develops, keep your eyes on policy updates, Fed signals, and market reactions, because the next big move could happen faster than most expect, and those who are prepared will be in the best position to benefit. If you found value in this breakdown, make sure you stay connected, because we'll continue to analyze the biggest market-moving stories in real time, helping you cut through the noise and focus on what really matters for your portfolio. This is Stock Predictor, and we'll see you in the next one.